Have you ever looked at a tiny startup, maybe with just 10 people, and wondered how on earth they offer the same amazing health benefits as some giant corporation? It seems impossible, right? Well, the secret is all in something called group insurance. So let's dive in and see exactly how they pull it off.
I mean, this is the million-dollar question for so many small businesses, isn't it? How can you possibly compete for the best talent when you're going up against the big guys with their incredible benefits packages? It feels like a totally unfair fight. But it turns out there are some pretty clever ways to level that playing field.
And that's where this core idea comes in: group purchasing power. It's really just the old saying, strength in numbers, applied to health insurance. The whole idea is that by teaming up, a bunch of small players can suddenly get the power of a giant.
So, how does this actually work in the real world? It's definitely not just a handshake deal. There are specific legal structures that make all of this possible. We're going to dig into two of the biggest ones, and they go by these acronyms, MMET and MEWA. Let's decode what those actually mean for you.
Okay, first up, we've got the Multiple Employer Trust, or MET. The easiest way to think about this is like a health insurance buying club for small businesses. All these separate little companies pool their employees together, and the trust they form acts like one giant customer buying a massive insurance plan. And because they're buying in bulk, they get a way better price than any of them could get on their own.
Then you've got the MEW, a multiple employer welfare arrangement. Now, this is similar, but there are a couple of really important twists. First, everyone in a MUA has to have some kind of common bond, like they're all part of the same trade association. And second, they often self-fund their benefits. And that self-funding part, that changes the whole game. We'll get to what that means in just a sec. So let's put them head to head. On one side, you have the MET, which is basically going out and buying a big traditional insurance policy for the group. On the other side, you have the MEWA, where the companies are pooling their own money to pay for claims directly. And remember that key difference in who can join. A MEWA needs that common bond, while a MET is generally open to any group of small employers.
I know. That phrase, self-funded, can sound kind of scary, right? Like you're totally on your own if something bad happens. But it is so important to understand this. Self-insurance does not mean no insurance. It's just a different way of handling the money.
So here's the deal. The employers create this big pot of money, a trust, to pay for all the routine, expected medical bills. But what if something huge and unexpected happens, a catastrophic claim? Well, that's where stop-loss insurance kicks in. It's a special insurance policy for the employer that covers those massive claims. It's the ultimate financial backup plan. Okay, so you've got your coverage. Great. But what are your actual rights here? What protections do you have as an employee on one of these plans? Well, federal law has your back with some really important protections you've got to know about.
A huge one is the Pregnancy Discrimination Act. The law is super clear on this. For any company with 15 or more employees, their health plan has to treat pregnancy, childbirth, and anything related to it just like any other medical condition. No exceptions. It's all about ensuring equal treatment.
And then there's HIPAA. And this is so important if you're ever thinking about switching jobs. Because of HIPAA, when you move from one job with health insurance to another, the new insurance company can't just slap a pre-existing condition exclusion on you as long as you didn't have a big gap in your coverage.
And that brings us to this super important term, creditable coverage. Seriously, remember this one. As long as you keep that continuous coverage without a gap of more than 63 days, it acts like a golden ticket. It lets you carry your health history over to a new plan without getting penalized for it. This is exactly why avoiding gaps in your health insurance is so critical.
But let's talk about the stressful part. What happens when your job actually ends? Whether you decide to leave or you get laid off, it can feel like you're walking a tightrope without a net. But thankfully, there are powerful laws designed to help you navigate this and avoid those dangerous coverage gaps.
And that's where COBRA comes into the picture. Now, the key word here, the most important word on this slide, is continue. See, COBRA is not a new plan. It's not a different plan. It's a law that lets you stay on the exact same group plan you already had, just for a limited time. So, how do you even get COBRA? Well, it all kicks off with what's called a qualifying event. The ones we see most often are pretty straightforward. You quit your job or you get terminated, as long as it wasn't for, gross misconduct. But it's not just about you. It also applies to your dependents, if there's a divorce, if the employee passes away, or even when a child gets too old to be on the plan anymore.
Now, you really have to pay attention to the clock on this one because the timeline is strict. Once you leave your job, your employer has 14 days to notify you about your COBRA rights. Then, the ball's in your court. You get a 60-day window to decide if you want it. And here's the part that catches people off guard. If you do say yes, you have to pay the premiums all the way back to the day your coverage originally ended.
All right, let's get to the big one, the cost. Because, yeah, this is where a lot of people get some serious sticker shock. See, while you were working, you were probably only paying for a slice of the pie. Let's just say, for example, your monthly contribution was $200.
But with COBRA, you're now on the hook for the whole premium, your part plus the part your employer used to pay. And on top of that, there's a little 2% administrative fee. So if that total premium was $500, your new monthly COBRA payment jumps all the way up to $510. It's a huge jump for sure, but the trade-off is you get to keep that same quality plan.
But you gotta remember, COBRA is just a bridge. It's temporary. It's not a permanent solution. So what happens when that bridge runs out? Well, that leads us to our final safety net, something called the conversion privilege.
This right here is so important. The conversion privilege means you have the right to change your old group plan into a new individual policy with that same insurance company. And here is the absolute game changer. You do not have to prove you are insurable. It doesn't matter what your health status is, they have to offer you a policy.
So, COBRA versus conversion. Which one's right? Let's put them head to head. With COBRA, you're keeping your old group plan, but it's only temporary. With conversion, you're getting a brand new individual plan, and it's permanent. Now, cost is a huge factor. COBRA is expensive, but an individual conversion plan could be even more. But look at that bottom line. The crucial thing they both have in common, your health status doesn't matter. You are guaranteed coverage with either one.
Okay, so what are the big takeaways here? First, small businesses are not out of the game. They've got clever options like METS and MUAS. Second, you have rights. You're protected by powerful laws like HIPAA and the PDA. And finally, if you leave your job, remember that COBRA is your temporary bridge, and conversion is your ultimate safety net.
You know, this whole system we've been talking about was really designed for a world where people stayed at one company for like decades. But that's just not our world anymore, is it? So the big lingering question is, as the very nature of work continues to change so fast, how should our benefits change right along with it? Something to think about, right? Thanks for sticking with me for this explainer.